Welcome, students and scholars. In the previous ASC 105 lesson, we learned how to navigate the codification and research gap questions with discipline. But finding guidance is only part of professional accounting. The next question is, how do we apply judgment properly? That is where materiality and the conceptual framework become important. Materiality helps us filter what truly matters in financial reporting, and the conceptual framework helps keep judgment consistent, logical, and connected to the purpose of financial statements. In this lesson, do not think of judgment as guesswork. Think of it as disciplined decision making guided by user needs, reporting objectives, and the quality of financial information. Judgment matters because financial reports are summaries of economic reality, not complete copies of every business detail. A real entity may have thousands or millions of transactions, estimates, contracts, adjustments, and internal events. If financial statements tried to show everything with equal weight, users would face information overload instead of useful reporting. Professional judgment helps accountants decide what should be recognized, what should be presented separately, what should be disclosed, and what may not need separate attention. This judgment is not arbitrary. It should be guided by materiality, the conceptual framework, and the objective of giving users information that can actually support decisions. Materiality is entity specific. There is no single dollar amount that automatically becomes material for every company. The same amount may be minor for a large multinational company, but very important for a small regional business. So, materiality depends on size, nature, and circumstances. Size asks how large the amount is in relation to the entity. Nature asks what kind of item it is, for example, whether it involves unusual activity, related parties, legal concerns, or sensitive reporting areas. Circumstances ask what is happening around the entity, such as industry expectations, debt covenants, regulatory pressure, liquidity problems, or current financial performance. Numbers are important, but numbers are only signals. A quantitative analysis may begin with amount, percentage, trend impact, or effect on a decision metric. But the number alone does not complete the materiality conclusion. For example, an amount may be small in absolute dollars but large compared with net income. Another amount may not be large by itself, but it may reverse an earnings trend or change a key margin. The real question is not simply how big is the number. The better question is, could this information influence the decision of a reasonable financial statement user? The nature of an item can change the materiality conclusion. A small adjustment that converts a profit into a loss can be very important because users may interpret the entity differently once the zero line is crossed. A small covenant related adjustment may become significant if it causes a debt breach or brings the entity close to default. A small entry may also matter if it helps management meet a bonus target, analyst expectation, or performance threshold. This is why materiality cannot be reduced to a mechanical percentage. The consequence of the item may matter as much as, or sometimes more than, the amount itself. Precision also matters in materiality judgment. Some balances are highly precise. Cash is counted, reconciled, confirmed, and usually measured with very little uncertainty. A difference in a precise balance is difficult to dismiss because the number should be highly supportable. Other balances are softer because they involve estimates. Warranty reserves, useful lives of assets, and credit loss allowances may involve ranges of reasonable outcomes. A small movement inside a reasonable estimate range may not mean the same thing as an unexplained difference in a precise balance. Good judgment considers not only the size of the item, but also how precisely the item can be measured. Now, let us move from materiality to the conceptual framework. The FASB concept statements provide the logic behind many accounting standards. They explain the objectives and principles that guide standard setting and support consistent reasoning. However, an important point must be clear. The conceptual framework does not override specific authoritative gap. If a codification standard gives a direct answer, that standard controls. The framework helps us understand why standards are designed in a certain way, and it can support reasoning when a situation is new, complex, or not directly addressed. In simple terms, the framework helps accountants think with structure, not just memory. The objective of general purpose financial reporting is to provide useful information to users who make decisions about providing resources to the entity. These users include investors, lenders, and other creditors. Investors want information about expected returns, business performance, and management stewardship. Lenders want to know whether the entity can generate enough cash flow to service and repay debt. Suppliers and other creditors care about liquidity, solvency, and credit risk. Across all these users, one theme repeats. Financial reporting should help assess the amount, timing, and uncertainty of future cash flows, and also help users evaluate how responsibly management has used the entity's resources. Useful financial information needs two fundamental qualities: relevance and faithful representation. Relevance means the information can make a difference in user decisions. It may help users predict future outcomes or confirm and correct earlier expectations. Materiality is closely connected to relevance because information is material when its omission or misstatement could influence decisions. Faithful representation means the information depicts the underlying economic event properly. It should be complete, neutral, and free from material error. Notice the balance. Relevant information that is not faithfully represented can mislead users, while faithfully represented information that is not relevant may not help users make decisions. Beyond the two fundamental qualities, financial information can be improved by enhancing qualities. Comparability helps users identify similarities and differences across entities and across periods. Verifiability helps users gain confidence that knowledgeable, independent observers could reach general agreement about the information. Timeliness means information reaches users before it loses decision value. Understandability means information is classified, presented, and explained clearly enough for reasonably informed users. But all of this is subject to the cost constraint. Not every useful looking disclosure or measurement is worth the cost of providing it. Standard setting always has to consider whether the benefits justify the effort, complexity, and cost. In this lesson, we connected professional judgment with materiality and the conceptual framework. We learned that materiality depends on size, nature, circumstances, consequences, and measurement precision. We also learned that useful financial information must be relevant and faithfully represented and can be strengthened by comparability, verifiability, timeliness, and understandability. In the next ASC 105 video, we will move from judgment to recognition and measurement. We will ask when an item enters the financial statements, how it is measured, and why present value matters. If this lesson helped you, please like the video, share it with your colleagues, and subscribe to Commerce Regiment for more structured US GAAP learning.